after a slippery open, U.S. stocks rallied on Friday. It appears markets deciphered a lot of mixed clues and, after some cause for concerns, decided that it was just easier to make a fresh high for 2023. And why not? The consumer remains optimistic, with the Consumer Sentiment Index rising to 64.9, which is a so very slight increase from the reading of 64.6 2 weeks ago. Elsewhere, gross domestic product, which is the sum of all goods and services, expanded at a 2.9% annual rate in the fourth quarter of 2022. For the full year, GDP grew 2.1%, so no recession here. Right now, the market is in no mood to go down. Two charts today, beginning here with the monthly chart on the 10-year Treasury. And I have to use big charts, which is a market watch product, simply because it's better than the other charts. And in the upper left here, you can see the symbol. You can pause the video to get that symbol and put it in here on big charts and get this information after you fill out these various boxes. Now, moving over here, this again is the 10-year yield. You can see that we were way up here in about 2007, came on down, and then we took a dive at this point here, but we've been on our way up for over the last 3 years. All the way up here, went above 4.25, but it's consolidated. Now, going into the MACD, you can see that through the history of this chart all the way back to 2006, this is the highest that the MAC has been in that entire time frame. So pretty soon it's going to want to take a rest. It's starting to roll over here, but there's still a separation between the slow line and the fast line here, which means there could be some volatility and some waffling. But looking at the slow stochastic here, you can see that it looks like it's rolling over, and then here in the Williams doesn't quite look like it's rolling over. Some sawtoothing going on here in the last couple of years, but I would imagine that this is going to break down as well. Back up to the chart one more time, and you can see here that this was one hell of a ride from 0.5% all the way up to 4.25%, and I think fatigue is starting to set in, but I think we'll still have a little bit of volatility here on the upside before it heads on down. All right, let's go to our charts. And now we're looking at the 20-year monthly chart on the spiders, the SPY. The close on Friday was 405.68. Now, as you can see, we started at that top at this point here, and we came down and then bounced back up, got reflected back down again off that 50 EMA. We're heading on up. It looks like we went through the 20 EMA. So this is some of the volatility that you should expect going forward. Simply looking at here, the histogram, the MAC, you can see the difference between the slow line there and the fast line here, and that means there's plenty of opportunity for sideways movement or volatility, and it's volatility that I would expect. Here in the histogram, we were very negative. It was very deep, the deepest that it's been in this entire chart. Now, even though things are improving, don't expect this line to continue on straight up to the zero line. There's going to be a test of the previous lows. Whether it's successful or not, I think we will have a test. Not sure exactly when it's going to come, but pay attention. Here, price rate of change, sawtoothing. Here at the bottom, it's trying to bottom and base, but we have more sideways movement or volatility before the fast line is going to cross up and through that slow line. Into the RSI definitely wants to bottom and base in this area here. It's come on up to the 50 or midline, but it's also possible that can get reflected back down and do some more sawtoothing. But keep your eye on the relative strength that is a leading oscillator. here in stochastics. This looks pretty good with the fast line moving on through. This is another leading indicator, but I'm not quite convinced because it's still relatively negative down here. Has a ways to go before it hits that 50 or midline. And then into the Williams, this generally leads all the oscillators. It's already up to the 50 or midline after hitting that maximum negativity back here. So this is saying the market is heading higher, at least in the short term. Again, it is only just coming through that 50 or midline, which means it's gaining strength, but it's still not strong enough to make the market head up too fast or too strong. Back up here to the market, you can see vacillating here in between the 50 and the 20 EMA. I expect some more volatility. We'll see how this recent run, how long it's going to last here, but expect more volatility. But get your cash ready, because very soon, if not already, there are stocks that are going to prove out to be good opportunities. So for today, that's ChewDog Charts. Thank you.